Welcome to my channel Kingmaker and I am Yogesh. This video is about financial planning. We will look into various aspects of financial planning that will help you achieve financial independence and retire rich. One of the safest methods backed by government is Public Provident Fund and the other one is Suganya Samriddhi Yojana. These methods are backed by the Government of India. Let's learn about PPF and SSY in the upcoming slide. Public Provident Fund and SSY invest our money in government debt schemes. They are very safe. They are secured by the Government of India. Any Indian citizen can invest in Public Provident Fund. But Suganya Samruddhi Yojana can be invested only on behalf of a girl child. Public Provident Fund has a lock-in of 15 years and part withdrawal is allowed only under special circumstances. Public Provident Fund can be extended in blocks of 5 years and closed on maturity. Suganya Samruddhi Yojana matures only when the girl child attains 18 years of age. Public Provident Fund and Suganya Samruddhi Yojana has a limit of 1.5 lakhs only per year. It is also has an exemption of up to 1.5 lakhs under ATC, which is old scheme. Under new schemes, you don't have any such options. It is extremely important for you to secure your future financial needs during emergency. The term insurance perfectly suits you to secure your family financially in when there is a loss of life of a breadwinner. Never go for endowment or ULIP policies and go only for term insurance. Do not mix investment and insurance. Term insurance premium is so cheap when it is taken early. You may take a policy for up to 10 times your annual income. Disadvantages of endowment policy is that it has a rate of interest of less than 5%. For example, a Jeevan Anand policy by LIC has a sum assured of only 5 lakhs for 20 years period and the premium per year comes to about 27,000 rupees, which is very. Housing loan principal is exempted under ATC and which is again a old scheme, and under new scheme you won't have such options. It gives a tax break of 1.5 lakhs per annum under ATC. Section 24 of the IT Act also gives tax exemption of up to 2 lakhs per annum for housing loan interest alone, again under the old scheme. Invest in individual house rather than apartment, as UDS you get only a very small percentage. Another important aspect is the health insurance. Most of us would have health insurance by employer or spouse. You should utilize the same. Remember to declare your marriage and childbirth so that your spouse and children get covered under this policy. For hospitalization, choose cashless if applicable. Also, utilize preventive health checkup offered by the insurer. Opt for an add-on based on your health condition and opt for family floater if needed. If there is no cashless option, preserve your original bills and claim later. Keep one copy for you as a safety because the reimbursement is provided against the actuals or originals. In case if you are right now in deep debt, then let's see what is important to do. Plan for credit card balance transfer. Debts as high as 48% per annum would become up to 12% if you go for balance transfer. Go for part payment or pre-closure of your loans by utilizing your annual bonuses or increments, if any. Avoid unnecessary debts. For example, a personal loan taken under credit card can be always avoided. Let's see another important aspect, systematic investment plan. It is a very powerful way to build wealth. You may start systematic investment plan in any category of mutual fund based on your risk profile. Try to avoid sectoral funds because they have very high volatility. But long term investment over a period of more than 7 years can actually be safe for any category of equity mutual funds. You may choose your long term goals such as retirement and marriage of your child and so on for these goals. Just as an example, if you keep investing 5,000 per month for 30 years at about 12% assumed interest, then it becomes about 1.75 crores on maturity, which is a huge amount. This can be achieved without much pain. Assess your financial health before choosing mutual fund category. Continuously invest in your SIP as far as possible. Many people have lost their money due to ignorance. Do not be ignorant in any financial aspect. If you are ignorant in, say, for example, share market or real estate, avoid those areas of investing. Hard earned capital needs to be protected. If you lack trading fundamentals, then do not trade in share market. If you are confident, then also have a stop loss to preserve your capital. Opt for long-term investment. The important aspect is emergency corpus building. Nowadays, due to job loss or salary reduction due to pandemic, we may have to manage our expenses over the period of up to 6 months maybe. In such a situation, you will have to build a corpus which lasts for this duration. Liquidity is the key here, and also capital protection is a must. So, invest in AAA rated liquid funds or FD. All expenses should be covered by you in this emergency corpus. One of the pension schemes backed by government is National Pension Scheme. It is more or less like mutual fund investment only. Up to the age of 60 years, you can keep investing in this and withdrawal happens after 60 years of age. You may withdraw under special circumstance, but in general, up to 60 years you have to keep investing, and finally you can withdraw after 60 years, but only up to 60 percentage. 60 percentage can be withdrawn at the age of 60, and 40 percentage should be invested in annuity to receive pension. We have come to the end. With these tips, I hope you have a better financial planning, happy investing, and do subscribe to my channel for more such videos. Thank you.